The interesting thing about gold, I recommended it at $1,100 an ounce, US, $1,200 an ounce, $1,300 an ounce, $1,400 an ounce, $1,500 an ounce. And people would basically yawn and say, whatever. And occasionally when people come up to you after the presentation and they say, Jim, I listened to you carefully. I agree with everything you said. I see this disaster coming. Please call me like 3 o'clock the day before and I'll sell my stocks and go buy some gold. And I have a two-part answer to that. One is I'm not going to know the day. I can tell you how bad it's going to be, but I won't know the exact day. And if I did, I might be a little busy that day myself. But my real answer is, what are you waiting for? If you agree that this kind of collapse is coming, why wouldn't you buy your gold now? First of all, at a more attractive price. Secondly, when you can get it. And the other warning I gave was that when you really, really want your gold, when you want it the most, you won't be able to get it.
I just want to clarify, you're recommending buying the physical gold.
Correct.
Yes.
And we can get into the reasons for that, because that is the only form of gold. Good luck finding it if you can. I mean, if you're the Central Bank of Russia, you can probably lay your hands on some. But now that everyone wants it, you can't get it, which is completely predictable. It's what we call conditional correlation. But, keep trying. And, my view is that gold will go much higher. There's still plenty of time and plenty of room to participate. But again, my answer to people is don't wait. As far as what I call paper gold, people buy gold futures on the COMEX. They'll buy unallocated gold forwards from banks who are members of the London Bullion Market Association. They buy gold ETFs. They buy shares in gold funds, etc. And they go, I've got gold. And I say, no, you don't. You have a contract. And let's see how the contract is honored when gold is most in demand. We're not quite to the super peak frenzy stage yet. I think we'll get there, but we're not. Well, as we approach that, you'll find these contracts will not be honored. And for example, again, just to be very specific, the gold futures contract on the COMEX, Commodities Exchange, part of the CME group. So they have designated gold warehouses. There's a certain amount of physical gold in the warehouses, but that amount of physical gold is trivial compared to the value of the gold contracts outstanding. So what would happen if all the people who were long futures stood for delivery? And that there's a procedure for that, which is, you just put in notice, say, what, I don't want to roll over my contract. I don't want to pair it off or buy it back. Just send me the gold. And you can do that. And they've always allowed that because they want to maintain the basis between the physical and the paper gold prices. But if the open interest is 100 times the physical gold and everyone wants this gold, are you going to get your gold? The answer, of course, is no. And so they have a rule. I'm actually enough of a geek. I've read all these rule books of all the exchanges. I'm a lawyer, by the way. So there's a big part of my career was kind of regulatory practice. Every major exchange has a rule that says they can change the rules. And so when they do that, everyone whines, you changed the rules. Like, well, no, we didn't. We have a rule that says we can change the rules. Get ready. So what they do in these situations, it is and isn't the train wreck people imagine. It isn't in the following sense. When the demand for delivery overwhelms the amount of physical gold, they issue an order that says you can trade for liquidation only. What that means is that if you're long, you can sell and close out your contract and collect your winnings, or you can roll it over to a future month, but you can't get the gold. You can't get the physical gold. And that will, kind of save the exchange. But you're sitting there saying, well, no, I want my gold. This is why I did this. Sorry. They'll send you a check for your profits. I'm not saying they're going to steal your money, but they are going to deprive you of the opportunity to get your hands on gold. And the exchanges all say, we are not a source of supply. We only allow a limited amount of physical delivery to maintain the basis, but we're not a source of supply. So you'll be disappointed there. Now, LBMA, unallocated gold positions or gold forwards, the word unallocated should give you a clue. What that means is you have one 400-ounce bar. They could have tons of it, whatever, but just I'll use an example of one 400-ounce bar. They can sell that bar to 100 separate investors, and they do. So there are 100 people out there who think they own a 400-ounce bar, and they have a contract that says that, but there's only one bar in the vault. It's the same thing I described with the futures exchange. Now, those customers can send notice to the bank and say, please convert my account from unallocated to allocated. What that means is that, okay, now there's a bar with a serial number and a register, a ledger, and your name's on it. You own that bar. Well, how are they going to do that if 100 customers say, please convert it to allocated, and they only have one bar? Well, they're going to have to go out and buy 99 bars.
This is fractional reserve for gold.
Well, no, it is, except there's even more leverage in the banking system, if you can believe that. So they're going to have to go buy, 99 bars to do that. We can't do that. So what will they do? Again, the geek in me has read these contracts. There are force majeure clauses. There are termination clauses. They'll send you a note saying, sorry, your contract has been terminated as of the close of business yesterday. Here's a check for your profits. Nice knowing you. And you'll say, well, no, wait, where's my gold? It's like, sorry, read the contract. And so and same thing with ETFs. I don't have to get into all the technicalities of all these, but my point simply, an ETF is not gold. It's a share. It's a share in a trust traded on the New York Stock Exchange. What if they close the exchange? What if, et cetera? So my point being, people who think they have gold in paper form, be it futures, forwards, unallocated forwards, ETFs, et cetera, don't have gold. They have contracts. Contracts have escape clauses, termination clauses, force majeure clauses, it's various covenants. They can all be terminated. They will be terminated when the time comes, and those people will not get their gold.
Gold's track record is clear, and so is the US dollars. Fiat currencies have come and gone, but all the while, gold and precious metals have stood the test of time. Get started protecting your retirement savings today. See the links in the video description to get access to the free gold investment guides from the best gold IRA and gold investment companies that we have personally researched and vetted. You have nothing to lose, but you have wealth to keep. Thank you for watching.